Hi there, welcome to Kneppy Invest. One of the reasons I started this investing YouTube channel was to share ideas with you, the viewer. And one of the ways I get ideas, not only from reading announcements on the ASX, but also listening to podcasts and reading articles. So I do read a lot of articles, investing articles, and I do listen to quite a few podcasts as well. And one of the ways you can get these ideas is just to read articles like Livewire's #1 stock picks for 2023. This was also turned into a podcast. So have a look out for Livewire's podcasts and just go to their website and you'll see plenty of investing articles on their website. It's a trove of information. So in today's video, I'm going to share you the ideas that were shared in Livewire's #1 stock picks for 2023. Livewire asked about 15 analysis for their #1 stock picks for the year. And it's really interesting to see the variety of companies, not only ASX companies, but a few non-ASX companies as well. And here are a few of the fund managers or stock analysis that they did ask what their #1 stock pick for 2023. And you might know some of these names, particularly if you do listen to a lot of podcasts, watch Ausbiz the core, or just Ausbiz itself. So some of the names that I do definitely know here include Ben Clark, Matthew Kidman, Marcus Padley, and June B. Lau, probably definitely saying that name wrong. A few of those are either on Ausbiz, they do their own podcast, that sort of thing. So let's get stuck into it. And a lot of variety when it comes to also the fund management companies here, including Tribeca Investments, Marcus Today, Wilson Asset Management, Yara Capital Management, Collins Street Asset Management, Platinum Asset Management, and Perpetual Asset Management as well. And of course, TMS Capital. Now, I'm not going to be critical of any of these selections because I think it is one of the hardest things to do in investing is try to determine which company is going to perform well over the next year. It's sort of a time, there's a time constraint there, and it's really hard to know what the overall market's going to do, what the company itself is going to do as well. And for some of these fund managers, I don't think they got the memo or really understood the memo that this was only talking about 2023, not for the next 3 or 5 years, because some of the selections in the commentary, they did mention that this company, they expect to do well over the next 3 to 5 years. So I think it's a hard task to pick a company that's going to perform well over the next year. So I'm not going to be critical of any of these selections, because if I am critical of a selection, there's a possibility that that selection is going to be the best performer among these group of companies. Anyway, and even though I won't be critical, I will say some negative things about these selections, but also try to say some positive things about these selections as well. So the first company here from Romano Salatena from Katana Asset Management is Mineral Resources. Now, I'd probably classify Mineral Resources right now as a cult stock. We have seen the share price of this company rise from $12 to $88 in 3 years. And I do remember hearing about Mineral Resources from Emma Fisher from Airlie Fund Management or something like that. She was really hyping this stock up back about 3 or 4 years ago when the share price was around $10. And I didn't hear much else in regards to this company, but over the past few months, I just keep hearing Mineral Resources being mentioned in podcasts, being mentioned by fund managers, and that's the reason I consider this company to be a cult stock right now, and probably the reason why the share price has run up from $12 to $88 in 3 years is because of its cult-like qualities. And I'll probably also say the share price has run up from $12 to $88 without any likewise increase in the financials, but the future does look quite promising for this company. And the chart looks absolutely fabulous. So have a look at the weekly chart to understand why I think that's an absolutely fabulous looking weekly chart. Now, this company is into lithium hydroxide, and in the commentary here, they mention, or he mentions, Romano mentions, it's a top 5 lithium producer globally. It's also a top 5 iron ore producer, and Mineral Resources was probably more well known because of its mining services, and they're the largest contract mining services company in the world today. So a lot going for this company moving forward. In the commentary here, Romano also mentions their land holding. So they are the largest landholder in the Perth gas basin. He mentions that is a positive. And he also talks about the management. And he regards the management team as one of the best in Australia. And I have heard that quite often, a few times in the past few years. So a lot going right for Mineral Resources. But to say that this will be the best performing company in the next year, I think we will have to see this hype continue, this cult-like quality to even be enhanced over the next year for this to be the #1 stock pick on the ASX, or actually in the world, because not only is this among ASX companies, it's also worldwide companies, as you'll see in the next company. And the next company is one I have never heard of before, Constellation Energy. And there's a few reasons I've never heard of this before, but Constellation Energy is the largest producer of carbon-free energy in the United States, with nuclear, wind, solar, natural gas, and hydro. They create enough energy to power 15 million homes. Some of the states they do provide energy to include Texas, Pennsylvania, New York, among about 10 or 15 states. So they do provide electric power, natural gas, and energy management services. Now, this company is a recent listing. I think it was on the NASDAQ or maybe the New York Stock Exchange. But they were spun out of another company called Exelon at the start of 2022. And then have a look at some of these numbers. $19.6 billion in revenue, 12,000 employees, and a market cap of $27.5 billion. Yet I have never heard of this company. And there are some very large companies, not only in the United States, but the world, that I've never heard of before. Most very large Australian companies I have heard of. Now, the chart looks really nice from when it listed. There was or has been a slight pullback from $97.50 to $82 in the last few months. And that could be a nice buy-in position right now for this company. Now, recently, and this might be of interest to those who are a little bit older, but this was the owner, this is the company that owned the 3 Mile Island nuclear plant. And that particular nuclear plant, if you do remember, there was a partial meltdown back in March of 1979. I think they probably made a movie out of that or something. And they recently retired that plant in 2019. Now on to Ramsay Healthcare, and I'm going to totally mispronounce the name, June B. Lee, who is regularly on Ausbiz The Core, probably does other segments on Ausbiz as well, but I don't watch other segments of Ausbiz. I do like June B. Lee a lot, and her choice as the best performing stock in 2023 is Ramsay Healthcare. This was a little bit of a surprise to me, but I do understand her reason. It's all about electric surgeries, which haven't been performed over the past few years because of COVID-19. And the question is how beneficial that will be for Ramsay Healthcare moving forward. And the argument is that, or my argument is, maybe the market did not punish Ramsay Healthcare enough over the past few years, because we did see a bit of suppression in the profit and a slight suppression in the revenue, but not that much, but definitely in the profit. I think the profit fell about 50% because of these COVID-19 issues. So when I do look at the P ratio of this company, about 40 right now, and that suggests to me that the profit would need to double in financial year 23 or financial year 24 to justify the current valuation. But I think that definitely could happen if you go back to financial year 19, so pre-COVID-19, where we did see the profit double than what it is right now. Now, when you do look at the chart, it's probably I wouldn't say an ugly looking chart, but it's a very uninspiring chart with the share price going sideways over the past 8 years. And I would classify Ramsay Healthcare as a mature company. The growth in this company did come to a completion, well, the good growth in the company did come to completion in about 2015 or 16. If you remember, and maybe you haven't been investing this long, this was a great company to have in your portfolio in the 2010s because the share price ran up a lot during that decade. And then all of a sudden, that growth stopped in the share price, and the share price has been going sideways ever since. So, an interesting pick here. I'm not sure it will be one of the best performing companies on the ASX or even in the world, but I definitely can see the reasoning behind why someone would pick this company. Now, not every fund manager took this stock picking game seriously, and the one fund manager who did not take it seriously was Marcus Padley. And to be honest with you, I can't blame him because it is a hard task trying to pick the company that's going to outperform every single company. In fact, I'd probably call it impossibility. So Marcus Padley has decided he's not going to do the stock picking himself. He's going to let someone else do it. And that someone else turned $189,000 into $36 million by picking one company. And if I remember the story correctly, and I have heard this story, it could be a completely different person. But this person went from Kinman Resources. Then Kinman Resources was bought out by Wesfarmers, and then he put his money into Liontown Resources, and now it looks like he's put his money into Latin Resources, and that's why Marcus Padley has chosen Latin Resources. Very interesting sentence he has included in the commentary. The name of the game is to find a stock, buy millions of it, and then tell everyone else about it. That sounds very similar to a pump. Not quite the pump and dump, because there's no dumping right now, but that sounds very similar to a pump. So it's very interesting to see all the other fund managers taking this little game seriously. But Marcus Padley, I think, has swung for the fences with this particular pick. And even though the market cap of Latin Resources right now is around about 260 million, it might significantly increase from here. I just don't know what's going to happen in lithium this year. It is under a little bit of pressure right now, but all the luck to Marcus Padley. And to be honest with you, if someone asked me to pick one company that's going to outperform all the other companies in 2023, I might have swung for the fences as well. Now on to Oscar Oberg, the lead portfolio manager at Wilson Asset Management, and he has chosen Estia Health, which is really interesting because the chart looks absolutely woeful right now. But just because the chart looks woeful now doesn't mean it won't look really good in 1 year's time. In fact, the share price has been going sideways over the past 2 years. So maybe saying it's woeful is a disservice to the company, but the share price has decreased from $7.50, the all-time high in 2015, to a current share price of $2. So when the share price decreases like that over a 7 or 8 year period is not a good sign moving forward. So there's some interesting points that Oscar has mentioned in this particular commentary, that currently Estia is selling at property value. So the rest of the company is absolutely zero value. So it's almost free. Negative sentiment in the sector over the past few years might be turning around. Regulatory tailwinds possible, which would be beneficial for Estia Health, and also possibility of less competition because of more regulation. Now, the only thing I have against this particular pick is what he says down the bottom, the last sentence in the last paragraph. So we actually think that this business can double over the next 2 to 3 years. So this seems like more of the long-term pick, talking about 2, 3, 5 years, than just a 1 year pick. So that's probably the only thing going against this company right now, apart from the other negative things I have mentioned, including the chart. A really interesting choice here by Robert Gregory, the portfolio manager at Glenmore Asset Management. Don't know that asset manager or that fund manager. He has chosen Retail Food Group. Now, if you go through his commentary, he hasn't mentioned the chart at all, but the chart for this company is absolutely fantastic right now. I'm talking about the short-term chart, not the weekly chart. The share price has moved up a fair bit over the past month or so. Right now, the share price is about 9.3 cents. Wasn't that long ago where the share price was struggling to stay above 5 cents. Now, the AGM in November, the 30th of November, was the catalyst behind this run-up in the share price. So obviously, there was something really positive that was seen in or at the AGM. And Robert Gregory says he has a valuation of this company at around 11 to 12 cents. And the share price is getting towards or moving towards that valuation. So a very interesting pick. And the only reason I'd probably choose this company is solely based off the chart. And here is the chart for RFG, Retail Food Group. I totally forgot I included this in the video. And you can see, if you go back to 30th of November, there was a pretty big update. Share price had been going sideways from August through to the 30th of November. And then all of a sudden, we saw the share price rise in 2 consecutive days on the back of the AGM, and the share price has continued to rise after that. You can see after those 2 big updates, the share price went sideways. That's a really strong sign that there are no sellers, or there's very minimal sellers, and then the share price has kept on rising from there. So the share price has risen from 5.5 cents, 5.5 cents before the AGM to a current share price of 9.3 cents. So a nice rise in retail food group over the past month and a half. Now to Catherine Orfrey, the principal and portfolio manager at Wavestone Capital, which she co-founded in 2006. So co-founder of one of these fund management teams. Interesting choice here. Domino's Pizzas, even though she mentions in the commentary the company is facing some tail or headwinds over the next 6 months or so. Although if you look at the chart, the share price is trying to move into an uptrend. And when you consider the PE ratio of this company is 40, it needs amazing growth to justify the current valuation. And in my opinion, this company has that potential for amazing growth over the next 3 to 5 years. So I do think this is a long-term play or story. And Catherine Orfrey actually mentions that in her second paragraph. And she says, we always look 3 to 5 years out when we are looking at a story. So obviously she did not get the memo that this is only talking about 2023. It's not talking about 2023 to 2027. But I definitely think Domino's Pizza is looking way more interesting now than it was a few months ago. However, a few months ago when the share price fell to like $50, the valuation was there. I think that was really good value for this company. So again, this is a long-term play, and the chart is starting to look much better than it did a few months ago. Now to a company that actually I do own. I have in my portfolio just because I think it's really good value at at the current prices. And this pick was done by Dion Hershen, the executive chairman and head of Australian Equities, Yarra Capital Management. Now the share price and valuation has fallen significantly over the past, we'll say 6 months to 9 months, where it's reached very attractive levels. PE ratio right now is 14. That's after a bounce in the share price. In fact, the share price has bounced from about $2.80 to $3.50. And when the share price was about $2.80, which was almost the all-time low for this company, the PE ratio was nearer 10. So share price has bounced over during the first 3 weeks of 2023. And the valuation is the main selling point by Dion. In fact, he talks about the PE ratio being about 11 or 12 times forward earnings. So that does seem fairly cheap for a company that is growing. And even though there are some headwinds behind this company right now, I think those headwinds are short term, and they're definitely not some company-based headwinds. They're just sector and economy-based headwinds. So I think the future does look much brighter for Reliance Worldwide Corporation than what the market is thinking right now. And these are the times to find these quality companies that are looking very cheap right now. Now onto Matthew Kidman's selection, and I don't know him personally, but I know the name Matthew Kidman from his days at Wilson Asset Management as a CEO there between 1998 and 2011. Now he's the principal and portfolio manager at Centennial Asset Management, and just the name Matthew Kidman, I think, is pretty well known in investing circles. His choice is quite interesting. It's Generation Development Group, ticker GDG. I know nothing about this company, but just gazing at what they do and seeing that the CEO is Grant Hackett. Yes, that Grant Hackett, the swimmer who did win gold medals. I think he did win gold medals. He's a CEO of this company. Now, what does Generation Development Group do? They provide development capital to financial sector businesses. They have a markup of $250 million. It's really interesting to see exactly what they do. For instance, they sell an interesting product called a light bond. According to Matthew Kidman, this is in competition to superannuation, but much smaller and is a tax-effective product. They also launched an annuity product and also have a shareholding in ratings agency Lonsec. So it's small, illiquid and forgotten. And for those reasons, I don't mind this pick at all, because particularly of its liquidity, any sort of excitement in the market around this company could see the share price run up a fair bit. It could double, triple, or quadruple just if we see an increase in interest in this company. So I don't mind this pick at all, even though I don't know the company at all. Now on to Nick Slater, the Executive Director at LSN Capital Partners. He has chosen Hanson Technologies. And to be honest with you, this is a safe, reliable company that will not shoot the lights out this year. And this is coming from a shareholder. Yes, I am a long-term shareholder of Hanson Technologies, and I don't expect this company to perform exceptionally well this year. I think it'll be a solid performer, but it's going to be a solid performer this year, a solid performer next year, a solid performer the following year, but there won't be a year where you will see the share price double or even triple in that 1 year. In fact, the share price has been going sideways for 2 years, and even though it's been going sideways for 2 years, the PE ratio is still 24 at a market cap of $1 billion. So I do like the company, but I just don't think this company will shoot the lights out in 2023. Mary Manning, the portfolio manager at Affinity Investment Management, has chosen a very interesting company, a company that I have been thinking about taking a position in recent times. So the last 2 or 3 months, I have been thinking about buying into Mercado Libre, which is a Latin American e-commerce business. They are diversifying, growing at fantastic rates. For instance, $4 billion of revenue in 2020, $7 billion of revenue in 2021. In the most recent quarter, $2.7 billion. So if we analyze that most recent quarter, we are talking about revenue at $10 billion. However, the market does know about this company. The current market cap of Mercado Libre is $54 billion, and they are barely profitable. Because they are barely profitable with a market cap of $54 billion, the PE ratio of this company is 200. But I do expect the profit to increase at substantial rates over the next 5 to say 10 years. So her reasoning behind choosing this company is sound and justifiable. It's a Latin American e-commerce, and that should grow significantly in Latin America over the next, say, 5 to 10 years. She also mentions that Brazil is ahead of the rest of the world in terms of the macro. They've raised interest rates 13 times, over 1,000% since the bottom, but now they are starting to be on hold and actually starting to cut interest rates expected for next year. And she also mentions unemployment has peaked and inflation has peaked. If you think about what's going to happen in the US and Europe in the next 18 months, Brazil is already there. And we started to see the share price turn around. Share price has been coming down or going down. Now it looks like the share price is wanting to move into an uptrend, and that is why I'm a little bit more interested in taking a position in this company right now, because I think the low for the share price has been reached. Now onto a current trading stock of mine. I bought into this company because the share price had moved into an uptrend. This was maybe a year ago, and the share price has just kept on increasing since then. In fact, I think I have included the chart in the next slide. So MA Offshore has been chosen by Michael Goldberg, the Managing Director and Portfolio Manager at Collins Street Value Fund. Now, there are some reasons to be excited about this company right now. The share price is in a beautiful uptrend. You'll see that when we look at the chart. It's in the right sector, and the company has diversified its services over the past few years. So they were more concentrated. Now they're diversified, but since in the right sector in the energy space as well. Not all the services are to offshore oil and gas, but they do provide a lot of services to that sector. And we have also seen a profit upgrade from the company released recently. You'll be able to see when the company released that profit upgrade when we look at the chart. So let's have a look at the chart now and why I'm excited about this company just based off the technicals. This is one of the best looking charts on the ASX, and I try to emphasize one of. It's not the best, it's one of the best, because when you look at this particular chart, you can see going from the bottom left to the top right. And as a shareholder, that's the sort of company you want to be owning. And the share price since I bought into this company has more than doubled in just about 1 year. And that's exactly what you want to see for a company you own. Now, I wouldn't call MMA Offshore a high quality company, so I am trading this company. Just ride the positive sentiment, ride the uptrend. And not only that, the company did release a profit upgrade in the middle of December. It was a nice profit upgrade, justifying the positive sentiment behind this company. And the share price increased a fair bit on that day. And since that day, the share price has been going sideways, which is really positive. That means there's not a lot of sellers out there driving the share price down. So whenever you see a really big jump up in the share price in one day, what you don't want to see is a massive decline in the share price back to where the share price was previous to that major climb. What you prefer to see is a share price going sideways, just consolidating. And it wouldn't be surprising to see the share price start to trickle upward from here over the next few months, particularly if they release their results in February, and the results are looked upon by the market quite favorably. So I'm still fairly positive, bullish with MMA Offshore, and the one reason I would be owning this company is just based off the chart. I didn't even read the commentary from the guy who selected this because it's not about the overall business itself, it's just about the chart. But that's just my opinion. Now on to another company I have never heard of before, and this is ZTO Express, a parcel delivery company in China. And according to Andrew Clifford, the CEO and co-chief investment officer at Platinum Asset Management, the guy who chose this particular company, because of e-commerce in China, there is a lot of potential of growth for this company, and there's also a decreasing in competition. Not only that, the company itself is growing quite quickly. Profits up 70 to 80% in the last few quarters. And at this point in time, you can buy this company on around 15 times next year's earnings. Now, I did have a look to see whether I could buy this company through my super fund, but I cannot. Net Wealth won't allow me to buy ZTO Express. So I thought I won't look further into this company. But it's really interesting that Platinum Asset Management, because you can trade that company on the ASX, the share price is turning around, looks like, for that company. So Platinum Asset Management has popped up onto my radar over the past few months because of a shift in sentiment, or possible shift in sentiment, possible change in the trend in the share price as well. So if you do like ZTO Express, but you can't buy it, maybe you can sort of indirectly buy it by taking a position in Platinum Asset Management. Now onto a company that probably most of you have never heard of, LGI. This is an ASX listed company, and probably the reason you have not heard of this company is because they are a recent IPO. So they listed on the ASX on the 4th of October 2022. So typically I don't invest in a company until they spend at least 6 months on the ASX. So we haven't reached that point yet for LGI. But when you do look at the chart, it's quite favorable. The share price has increased from $1.58 to $2.29. So the share price is in an uptrend. Not only that, what they're doing and the potential for significant growth in the future has me intrigued with this company. So they provide carbon abatement and renewable energy solutions with biogas from landfill. So they do have exposure to carbon credit prices. And one of the reasons why Anthony Oberg, the portfolio manager at Perpetual Asset Management, chose this company is because of those carbon prices. And if they increase significantly in Australia, this company will benefit. Now, I do have a video on the cards for this company because not only the chart looks really good, but I also think there is potential for significant growth in the future for LGI. So definite company to put on your watch list, and look out for the video that I will do on this company over the next few months. And now on to the last company chosen by Ben Clark, the portfolio manager at TMS Capital. Ben Clark is regularly featured on Ausbiz The Core, and I really like this guy. I like his investing style, which makes sense because his pick is a company I have in my portfolio because I'm fairly bullish about this company over the long term. Not sure about 2023, but definitely the long term. So I won't talk much more about Aristocrat. I think this is a solid pick. Have no idea what the share price is going to do in 2023, but a very good, safe pick for the long term. That's all I have for Livewire's #1 stock picks for 2023. A nice, diverse, eclectic selection of companies from these fund managers. A few companies in this list I already have in my portfolio. A few companies I've never heard before, but I will do a little bit of research on, and a few companies that I am quite keen on for the future. So if you do have any thoughts about any company featured in this particular list from Livewire, leave your thoughts, your commentary, whatever you want in the comment section of this video. Otherwise, I'm not a financial advisor, unlike everyone in this list who chose some stocks. So if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.